Did the price of an H20 chip in China just go up overnight?
By 15%. I mean, look, the reality, it's the cost of doing business, right? And I think when you look at Jensen, you look at anyone in the semi world, you need access to China. And it comes down to this is ultimately the path that they're going to have to go through. And look, in investors, it's a headline sort of risk or shocker. But the reality is that you need to get into China. It's what you got to do.
Given where we were a few months ago, is this an improvement?
Oh, it's a massive improvement. I mean, if you go back to some of those dark days, where we were in April, some of those Armageddon days, it's showing at least now there is negotiations, right? And in that, it's essentially a game of high-stakes poker. So when you look at what's happening in tech, just like we saw with Cook at the White House and everything else, it's like, okay, if you play nice in the sandbox, that's going to be how this is going to work, at least for the next 3.5 years. And I think for big tech, you don't want to be on the outside looking in. And it's essentially the deal you can't refuse, right? I mean, to quote Godfather, it's like this is one where tech companies need to go down this route to get access to China. And I think on the other side, Trump administration recognizes, hey, if we don't give them access, it's going to make China that much stronger, Huawei, everyone else.
Is this the new rules of the road, though? You have to basically pay off the U.S. government?
Look, I mean, we're in unprecedented territory, and I do think you're starting to see big tech CEOs better understand the rules. And I think that's why if you're on the outside, it's not a good spot to be. Now, from an investor perspective, you'll pay the 15% tax to get access to China.
And that's worth it.
It's worth it because relative to the market and relative to the opportunity. And even though there'll be a lot of questions in terms of what this means, I think overall, relative to the last few months, it's much more bullish for U.S. tech and semis and Nvidia and the Godfather of AI, Jensen, and everyone else to have access to the China market.
While he did not completely rule it out, U.S. President Donald Trump hinted on Monday that he would not negotiate with the American AI chip firm NVIDIA, headed by CEO Jensen Huang, to permit the sale of a next-generation sophisticated GPU in China. Trump informed reporters that Jensen also possesses the new chip, the Blackwell. "It's possible, but I wouldn't make a deal with that," he remarked. Goldman Sachs recently adjusted its forecasts for Nvidia, the most popular AI chipmaker on Wall Street, which is set to face a significant earnings test later this month. With hyperscaler spending and China market developments as a primary emphasis, investor sentiment has shifted to one of optimism at the time of the reset. Analysts at Goldman Sachs are pointing out important levers that might determine the future course of Nvidia's stock as it continues to accumulate even greater profits. On August 27, 2025, after the closing bell, Nvidia is scheduled to release its fiscal Q2, July quarter earnings, and there are high expectations. Wall Street anticipates that Nvidia will report $45.70 billion in revenue, non-GAAP EPS of $100, and GAAP EPS of $93. Compared to previous year's $30.04 billion in revenue and $0.68 EPS, these figures show a huge increase. To put things in context, Nvidia estimated that Q2 sales would reach approximately $45 billion, give or take 2%, after accounting for lost revenue from previously halted H20 GPU shipments to China. Specifically, investors will be keeping an eye on these things. Blackwell ramp. Investors will be interested in learning about the rollout of GB200 NVL systems, especially when customers will receive their first units. Additionally, they will want to know if there is a beneficial effect on sales and how quickly the large rack-scale systems, NVL36, NVL72, are being implemented. Because of their size, these systems command higher average selling prices, ASP. China licensing. The United States has approved the sale of H20 MI308 GPUs to China, but will keep 15% of the revenues. Investors will be interested in the impact on Q2 profit margins and the potential growth in sales from China in Q3 and beyond. Gross margins. Nvidia's adjusted gross margin was 71.3%, following a significant one-time expense related to unsold H20 chips in the prior quarters. The importance of management's forecast is increased by their expectation that margins will recover to the mid-70% level later this year. Networking. The first quarter's networking revenue was an impressive $4.9 billion. Growth in this area might indicate a wider uptake of AI data center infrastructure and GB200 systems. AI capital expenditure signals. Google increased its full-year capital expenditure to $85 billion, while Microsoft anticipates investing $30 billion in Q3, demonstrating the continued tenacity of big tech's AI expenditures. Any connection to Nvidia's order backlog will therefore be crucial. Software monetization. More information on a new recurring revenue stream may be available with updates to Nvidia's AI enterprise platform and NIM microservices, particularly via Amazon's AWS marketplace. Nvidia will therefore need to produce a solid beat-and-raise quarter in order to sustain the surge, as sentiment is currently quite high. Nvidia just received a positive nod from Goldman Sachs ahead of its fiscal Q2 reports. Analyst James Schneider maintained his buy recommendation but increased his price objective from $185 to $200, or about a 9.5% potential upside from current levels. Schneider believes that the majority of investors are optimistic about the future outcomes and that investor mood is extremely strong. However, this increased optimism raises the bar significantly for Nvidia's second-half commentary and direction. Schneider anticipates a clean beat-and-raise quarter despite the more difficult competition and extremely high expectations. He believes that whether or not sales to China are included in the forecasts and whether or not guidance surpasses expectations will be the main factors influencing Nvidia's stock response. Schneider also increased its projections for data center sales by about 8% on average, citing mid-quarter data that showed high demand for AI and stronger than expected hyperscaler spending. Additionally, his sales forecasts for Q2 and Q3 of $41.9 billion and $51.5 billion respectively are 2% and 8% higher than Mr. Market's average. He continues by saying that Nvidia may generate an additional $20 billion in revenue and $0.40 in EPS by FY27 as a result of China sales returning to the internet. Schneider believes that investors will be closely monitoring Blackwell chips expansion outside of China in the coming future. Additionally, they will be curious about the trajectory of gross margins in the second half, as well as the potential impact of sales in China on margins. Schneider anticipates that in late 2025, the market's attention will turn to the possible course for 2027. Future growth signals are crucial because, according to him, a large portion of 2026's potential is already priced in, and his FY27 EPS prediction is 6.75. This year, Nvidia's stock has soared, rising over 54% in the last 3 months and about 40% in the last 6. Nvidia's stock is up 72% for the year, and its strong momentum is mostly due to its remarkable earnings run. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now let's get back to the video. As the demand for AI infrastructure keeps growing, the company routinely exceeded sales projections and produced 10 consecutive quarterly EPS beats. With revenues of $44.06 billion, up 69% year over year, Nvidia reported earnings of $0.81 per share in fiscal Q1 2026, April 2025, surpassing by $0.06. The company also reported $0.89 EPS, up $0.04 on $39.33 billion in fiscal Q4 2025, up 77.9% year over year, and $0.81 EPS on $35.8 billion in fiscal Q3 2025, up 93.6% year over year. Midway through 2023, the true momentum began as sales increased at triple-digit rates year over year. Additionally, Nvidia exceeded forecasts even in weaker markets. Quarterly sales are now over 7 times more than they were in early 2023, demonstrating the extent of its growth. It is impossible to forecast a company's position in 5 years. But when investors are purchasing a stock now, with the hope that its value will increase dramatically in the future, that is precisely what they must do. It's even more difficult when dealing with a business like Nvidia that is in a quickly evolving industry. The term generative AI was virtually unknown outside of the IT sector 5 years ago, when investors were caught up in the pandemic. It appears to be the only topic people can discuss these days. 5 years from now, will generative AI still be a major topic, or will it become obsolete? Many equities are greatly impacted by its direction, but arguably none more so than Nvidia. Graphics processing units, GPUs, produced by Nvidia are excellent at demanding tasks. Gaming graphics, which were among the most taxing workloads in the late 1990s and early 2000s, were the initial purpose for which GPUs were built. But GPUs soon found use in other fields, including as mining cryptocurrencies, drug research, and engineering simulations. In the end, that resulted in artificial intelligence, AI training, the biggest computer task that people have ever faced. Because they can handle a wide range of data sets, conduct various calculations in parallel, and be connected in clusters to scale up computing capacity, GPUs are ideal for this task. Nvidia has profited from the fact that GPUs are a reasonable choice for managing these workloads because of all these characteristics. Nvidia's income has increased dramatically since the start of the AI race in 2022. Nvidia's earnings occasionally more than tripled annually. Even if it has slowed recently, the second quarter of fiscal 2026 is still expected to see 50% growth. However, the U.S. government's decision to cancel Nvidia's export license to China hindered that expansion. That growth rate would have been 77% if sales of its H20 chip units, which were made especially to comply with the previous export regulations, had been taken into account. This quicker growth may return as early as the following quarter, as Nvidia has reapplied for its export permits with guarantees from the U.S. government that it would be granted. Although it's difficult to picture a corporation the size of Nvidia expanding at such a rapid pace, it has demonstrated, quarter after quarter, that there is an unquenchable need for AI. Will that, however, continue over the ensuing 5 years? Since all of the AI hyperscalers reported record data center spending at the beginning of 2025, most investors anticipated it would be a fantastic year for Nvidia. But after 2025, there were concerns about how much more demand there would be. Answers are beginning to come to investors. According to the most recent quarterly reports, the majority of large tech businesses raised their initial low 2025 capital expenditure, CapEx, predictions. Additionally, a number of businesses have predicted significant growth from 2025 levels. This is encouraging for Nvidia, which anticipates that this trend will continue for a while. According to a third-party estimate that Nvidia presented at its 2025 GTC event, worldwide capital expenditures for data centers came to $400 billion in 2024. By 2028, data center capital expenditures were expected to reach $1 trillion, according to the same forecast. That's a significant expansion, and Nvidia will gain greatly if it materializes. The short lifespan of GPUs is another element that will benefit Nvidia. They can malfunction after a few years of use and are used almost constantly, all year round. Depending on the estimate and their intended use, their lifespan can range from 1 to 3 years to as long as 5 or 7 years. The extensive use of Nvidia's products will result in a replacement cycle that may occur annually as the number of data centers rises. Because businesses will require these GPUs to handle AI workloads, this is encouraging for the chipmaker once more and solidifies it as a long-term investment option. In the next 5 years, I wouldn't be shocked to see Nvidia expand into a much bigger business because GPUs are always wearing out and more data centers are being constructed to enhance capacity. It will continue to be the biggest company in the world by market capitalization for many years to come due to its quick expansion and the extensive use of its GPUs. I believe it can consistently beat the market over the next 5 years, making it a sensible investment now, even though I wouldn't anticipate market-crushing returns like Nvidia has produced in recent years. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Let's talk about the U.S.-China trade truce, right? As you mentioned, that is the deadline for that is coming up. The temporary truce expires tomorrow. The last time I checked Truth Social, because often that's where we find out information from the president before there's an official release. What's the market reaction if this truce expires without an extension?
There probably would be maybe some volatility that creeps into the market, especially companies that have international exposure to China. I think the thought process right now is that there will be some form of a truce. And I know we're going to talk about AMD and Nvidia, but this could actually be one of those olive branches where they do create a little bit more of an extension, maybe another 90-day extension. And the Trump administration kind of goes on the back and saying, look, we were able to kind of make some concessions when it comes to chips and really putting the onus back on AMD and Nvidia in order to pay those, but once again, not levying that type of expense on China directly, probably once again gives a signal that we might see a pause. And I think the market's already pricing in for that. It makes it very hard for the White House and this administration to really try to execute a lot of these tariffs on China, just because of the cost pressures as well as the supply and logistic lines that are out there. Especially when you're looking at rare earth metals, obviously that's still been a very big focus area, but also when you're kind of looking at textiles and other consumer goods, they do not want to be the reason that inflation really does come back very aggressively, even though you can make the case that maybe inflation will probably edge up higher because of these tariffs that we've seen on a global scale here. So it seems the signals from the White House so far, just by their actions, kind of signifies the fact that they might be looking at a pause and looking at maybe an extension of 90 days. And any type of reversal of that pattern here over the next 24 hours probably would put a little bit more pressure on the equity markets as a whole.
KG, let me ask you, how does that, the NVIDIA, AMD, and the reports that we're seeing, how does that chip deal kind of intersect with this tariff negotiation process? Is this like seen as a bargaining chip? Is this some kind of leverage in some way?
Yeah, it's definitely a bargaining chip. I mean, if you kind of look at it, the administration's kind of changing its tone when it comes to these chips. At first, it was this national security issue, and now, if you pay 15% of the revenues from China, it's not a national security issue. That's what makes this a little bit more unprecedented here because of this abrupt change, and as well as the direct involvement, overt direct involvement when it comes to private enterprise, which is something that's a little bit unique. So if you kind of look at this type of strategy, you could also say that this is an implied tariff because Nvidia and AMD most likely will probably pass on that cost to their China counterparts in one way, shape, or form when it comes to prices, just like we would see for a normal tariff. It's just that the messaging is more towards, do you guys want really, do you want to export license or not? And if so, you got to pay up for it. And so it's definitely a bargaining chip, but it seems like they're trying to dampen down some of the rhetoric as well as tone down some of the actions from the administration to show an olive branch. And you can say that China has ramped up rare earth exports as well. We have seen some import-export data that does kind of reflect that. So it seems like China, from a headline standpoint, from what we know, looks like they're trying to hold up their end of the bargain here. And I think the United States is trying to figure out a way where they're able to adjust to be able to accommodate China, but also still try to gain revenue from these chip sales, which is, it seems like that's really the crux of the matter when it comes to this issue.